What's happening with stock markets? From about 42,000 in the month of January to about 26,000 by 23rd of March, a fall of about 38%. From there again rising up to 34,000 by end of April, a rise of about 30% from the low, to again back to about 30,700 as on today, a fall of another 9% from the highs. Now, given the kind of volatility what the markets are showing, many investors have questions which they want answers for. They would basically want to know whether is it a good time to invest into the markets, whether they should buy into equity mutual funds or shares, whether they should sell and come out of the market by kind of exiting their mutual fund holdings and equity shares and even stopping their SIPs. They have questions like whether the markets would rise further from here or whether the markets would fall further from here and could touch the previous lows what the markets had shown. They want to know whether they should still now sit in cash and wait for the markets to kind of stable down or settle down and then one should invest, or if they have to invest, where they should actually invest today. Now, investors have many such questions today for which they want answers. So in this video today, we'll cover all of these questions and we'll try and address all of these questions for all the investors. Hi, this is Kishan Jakhotia from Reliable Wealth, and this video is part of the learning initiative from our desk. I would regularly keep doing videos on current events, markets, products, and investment strategies. To receive all such videos from our desk, please subscribe to our channel and click the bell icon to receive notifications of all such videos that I would upload. Now, to understand how stock markets would perform, I think first we need to understand what is the situation of the economy, because ultimately stock markets are a barometer of how the economic performance is, and eventually over a period of time, stock markets reflect the economic performance. For the past 60 days, large parts of the economy have been under lockdown. Not just us, all large economies had to resort to lockdown because there was no other option left. It was a choice between lives and livelihoods, and by going for lockdown, we could save a lot of lives. Now, the impact of lockdown has been quite bad. Estimates suggest that the economic loss of output because of the lockdown would be about close to 20 lakh crores. How do we arrive to this figure? In the last year, our GDP was about close to $3 trillion, which roughly works out about 200 lakh crores. Estimates is that this year our GDP would fall by about -4 to 5%. So if our GDP last year was about 5% positive, and if we fall to about -4 or 5% this year, there's almost like about close to 10% type of an economic output fall this year, which works out about 20 lakh crores of GDP loss. This once in a lifetime type of an event has given a big blow to GDP, to jobs, to corporate earnings, to government revenues, and to every other economic parameter one could think of. Companies have been facing loss of production, working capital issues, and liquidity related issues. Employees have been facing salary cuts, job losses, and migrant workers are left with no work. Government is in a scenario where it would end up having lower revenues, there will be higher fiscal deficit, and rating downgrades for the country. Add to this some of the stock market specific factors like FIs pulling out due to their own liquidity needs, lack of demand and supply in the economy, lack of enthusiasm for stimulus from the market, and the market had shown this post the stimulus measures being announced, the markets corrected post which. The new rhetoric between US and China, which is threatening to again disturb global trade. Lack of enthusiasm from corporates during the recent quarterly results which they have come out with. Uncertainty of earnings in terms of how corporate earnings and growth would pan out. Expected default of corporates, and the fact that all of these factors have still not been priced into the market gives you some indication that markets can actually correct from the current levels. Understand the fact that during the 2008 financial crisis, markets actually fell in 3 different phases. Here in India, in this time, during the COVID times, we've just seen one phase of market correction. Maybe we'll end up seeing more volatile markets and maybe a few more phases of markets going up and down, and that can basically happen. But does this all mean that everything is negative about equity markets? Not really. The fact that if there is a sudden announcement on the vaccine could actually lift the entire market sentiments. The fact that if we could flatten out the COVID cases, that could again kind of give a lot of exuberance to the markets. So these factors actually can sideline all of these negative factors which the markets have, and actually change the sentiments, and the markets can actually recover and go up. Apart from the fact, Fundamentally, from a long-term point of view, equity markets today stand on a very good stead. The fact that from an earnings point of view, we have most of the statistical data points which indicate that market valuations are fairly reasonable today. If you look at, let's say, market cap to GDP ratio, whether we look at bond yields to earnings ratio, whether we look at the price to earnings ratio, ignore the fact that there are some companies in the markets which still today are extremely overpriced, but there's a large segment of markets which today even are at very reasonable valuations. Also, the fact that today our interest rates are so low that it will encourage corporates and a lot of retail public to go out and borrow and spend, which could reflect in corporate balance sheets over a period of time. The fact that our interest rates, the oil prices are so low, the fact that the global interest rates are so low and negative, where almost 14 to 15 trillion dollars of global bonds are actually in negative yields. This money could come and chase markets like India. So all of these are positive from a long term point of view. So yes, we have negatives, we have positives. Short term does look like the markets would be volatile or negative, but any news coming on the COVID side, or if we could flatten out the curve, you could see market showing a lot of exuberance. From a 3 to 5 year perspective, equities could end up giving very good returns. In fact, equity today probably is the only asset class compared to all the other avenues available today which could end up giving better returns. So now, what are the sectors which are positively affected by the COVID? The sectors which you should invest. What are the sectors which are negatively affected by COVID, which you should avoid? Now, the sectors which are negatively affected by the COVID issue are hospitality, tourism, NBFCs, real estate, infrastructure, industrials, capital goods, shipping, logistics, which are all the sectors which are positively affected by COVID. Pharma is positively affected, specialty chemicals, then consumer staples, few consumer discretionary counters, IT, telecom. These are all the sectors which are positively affected by COVID issue, and one should actually look at allocating into these sectors. Finally, what should be our investment strategy? Question number one. If the general view is that the markets are going to correct, why not sell everything and stop our SIPs? Now, this would basically be a very wrong move, because here it is just not about exiting the markets, but again re-entering the markets. So trying to time both the sides while exiting and while investing would not be possible for anybody. In fact, Warren Buffett says that timing is a very futile exercise and it's an absolute waste of time. So we should continue being invested. We should continue SIP investments in the market. Question number two. If I have liquidity in hand to invest, how should I go about my investing? Now, investors should invest in a staggered way over the next 12 months period. Well, I say this because assuming if one does not invest and if the markets go up, one would end up losing a lot of returns, or if one would invest fully and if the markets correct, one would also end up losing returns. So the best way in the current market to invest would be to invest in a staggered way over the next 12 months period. Question number three. Where should I invest? At this point in time, it is better to stick to large cap funds or large cap stocks, because large companies are expected to navigate through the current crisis in a better way than, let's say, a mid cap or a small cap company. So of your fresh investments, try to make sure that you would invest more of it into large cap stocks and less of it into mid and small cap companies. Also, from sector point of view, invest into those sectors which are going to get positively impacted by the COVID crisis, and avoid investing into sectors which are going to get negatively impacted by the COVID crisis. Question number four. Should I make changes to my existing portfolio? Yes. This is a good time to do a health checkup of your portfolio. Try and screen through your existing holdings and see if you have any holdings which are not good, which are underperforming, and try to replace them with better funds and better stocks which are expected to do well. Fifth and the last question. Should we reevaluate our holdings, say, 1 year from today? Yes. Given the fact that today the portfolio that we are making is a COVID-proof type of a portfolio, 1 year from today we will have to sit down, reevaluate and see what are our holdings between large cap, mid cap and small cap. And at that point in time, one could possibly be a little more aggressive in terms of the portfolio management. Also, this applies more to direct equity investors, because in direct equity, a lot of individuals will have to make those changes of going out of those stocks which ideally would have already performed and get into those stocks which have underperformed. Whereas in mutual funds, the fund manager would make those changes at the portfolio level. Two quick last points. First, always stick to your asset allocation. And second, take help of a good investment advisor, because navigating the current markets without any guidance will make it very difficult and one is prone to make big mistakes. Finally, if you've liked our video, please subscribe to our channel. Also follow us on all other social media accounts, the details of which are given in the description page below. If you have any comments to make about this video, please do so in the comment section. If you want us to do any other videos which you would like to know about, also please mention about them in the comment section. And finally, my number is here. You could reach out to me for anything that you would want to know. Thank you and stay safe.